Good morning, everyone. On behalf of Brickwork Ratings, I am delighted to welcome you all to today's webinar on India's FY25 growth, profits, and future prospects. My name is Vikrant Chaturvedi, Associate Director Research at Brickwork Ratings, and I'll be your moderator for this session. Joining me today are two of our senior analysts, Abhishek Das and Girish Basantani, both of whom bring deep sectoral expertise and analytical rigor to our discussion. Together, we will delve into the key drivers, sectoral performances, and the outlook shaping India's economic landscape as we transition from FY25 to FY26. Before we dive into our discussion, let me briefly introduce Brickwork Ratings. We are one of India's leading credit rating agencies accredited by the RBI and recognized by SEBI. We provide independent and credible credit ratings, research, and risk assessment services across a wide spectrum of industries, including banking, financial services, and infrastructure and corporate sectors. Let's begin by setting the stage. FY25 has been a year of contrast for the Indian economy. On one hand, we have witnessed robust GDP growth, with the latest reports indicating 7.4% expansion in Q4 and overall annual growth rate of around 6.5%. Driven by increased government spending and revival in rural development, and steady momentum in sectors like agriculture, construction, and real estate. However, this growth comes against the backdrop of a slowdown from the previous year's 8.2%. And with urban demand still lagging, the recovery remains uneven. As we look ahead to FY26, the outlook remains mixed. While rural areas and government spending are expected to continue supporting growth, risks persist from weak demand, stagnant earning forecast, and global uncertainties. Export performance and energy prices will also be crucial variables to watch. In today's session, we will dive deep into the macroeconomic scenario and key growth drivers for FY25, sector-wise financial results and profitability trends, the challenges and opportunities shaping India's future prospects as we move into FY26. Our speakers will share their perspective, followed by an interactive Q&A session where we welcome your questions. Once again, thank you for joining us, and we look forward to an engaging and enlightening session. Now for the presentation, I would like to invite Abhishek, who will share his insights in the industry.
Good morning, everyone. I am Abhishek Das, Senior Analyst at Brickwork Ratings, and I welcome you all to today's webinar. Let me begin with macroeconomic overview. India's economy showed resilience in Q4 FY25 with real GDP growth reaching 7.4% YOY, which is the highest quarterly expansion in the fiscal year. This was driven by strong domestic demand, infrastructure investments, and performance in manufacturing, construction, financial services, real estate, and public administration sectors. However, FY25 growth moderated to 6.5%, the slowest in 4 years, reflecting persistent global headwinds. The construction sector led the charge with 10.8% growth, supported by public infrastructure, urban real estate recovery. The Reserve Bank of India revised its inflation forecast for FY26 by downgrading it to 3.7%, citing easing food prices, robust agricultural supply, and favorable base effects. This inflation moderation provides relief to consumers and businesses, enabling a stable policy environment. Now I will talk about the macroeconomic drivers. Private final consumption expenditure reported a robust 7.2% growth in FY24-25, which was up from 5.6% the previous year, signaling a strong recovery in consumer spending. Investment activity measured by gross fixed capital formation increased by 7.1% in FY25, while 9.4% in Q4 FY25, primarily driven by business and infrastructure investments. India's exports increased by 6.01% in FY25, reaching 824.9 billion. However, global slowdown, trade disruption, and weak demand from key markets showed the place, while services sector provided some cushion. Monsoon outlook. The IMD predicts a normal monsoon for FY26, boosting agricultural output and supporting rural incomes. Global uncertainty, including oil price swings and geopolitical tensions, pose a significant threat to India's import bill, inflation, and export competitiveness, necessitating prudent macroeconomic management. Monetary policy. In response to easing inflation and a stable macro backdrop, the RBI executed its third consecutive policy rate cut in June 2025, marking a cumulative reduction of 100 basis points since February 2025. RBI also cut the cash reserve ratio by 100 basis points to 3%, releasing additional liquidity into the banking system. However, future rate actions are expected to be more cautious as RBI adopts a neutral stance, shifting its policy stance from accommodative to neutral, signaling a possible pause in its rate cut cycle. GST collections reached a record high of 2.37 lakh crore in April 2025, a 12.6% YoY increase, which was attributed to improved compliance, economic formalization, and strong consumption. India's macroeconomic fundamentals look strong, with private consumption and investments as key growth pillars. The RBI predicts 6.5% GDP growth in FY26, with construction, public administration, and financial services as key drivers. However, challenges persist in the manufacturing sector and employment generation, including tepid external demand, fluctuating input costs, and MSMEs margin pressures. Moving on to the next slide. Sectoral GBA performance and what drove growth in FY25. Let's break down the sector-wise GBA growth rates of real gross value added in India for the financial year 2025 and key drivers powering this growth. The construction sector led all others with a robust 9.4% growth in FY25 and a sharp 10.8% in Q4 alone. This performance was driven by continued government capital expenditure in roads, railways, and urban infrastructure, along with revival in real estate investment, especially in Tier 1 and Tier 2 cities. Moreover, resilient demand for cement and construction material supported this growth. Construction's strong growth was also created multiple effect across sectors like cement, steel, labor markets, and financial services. Public administration and financial services also recorded high growth, reflecting both increasing government activity and buoyant services sector. Agriculture sector experienced a 4.6% growth, largely due to a normal monsoon, improved rabi crop, government support, MSP hikes, and rural spending, which is a positive indicator for rural incomes and food security. However, mining sector posted a subdued growth impacted by regulatory bottlenecks and flat productions in some mineral categories. Further, manufacturing sector saw moderate growth as global demand slowdown and export headwinds affected output in some segments like textiles and electronics, suggesting areas for policy focus to further boost industrial output. Moving on to the next slide, which is about overview of India's performance in FY25 and how corporate India performed in a year marked by both resilience and moderation. FY25 was a year of resilience for corporate India, marked by robust domestic demand, a record in net profits, and a sectoral shifts amid a challenging global environment. India Inc.'s profitability reached a historic high in FY25 with net profit exceeding 15 lakh crore for the top 500 companies, thus setting a new benchmark in corporate profitability. This milestone was attained despite global macroeconomic headwinds and domestic cost pressures, underscoring the resilience and operational efficiency of Indian corporates. Significantly, the profit to GDP ratio for listed companies rose to 5.1%, marking a 17-year high. For the Nifty 500 universe, the ratio was 4.7%, also matching a 17-year high, a testament to strong earnings growth and improved margin performance across key sectors. This surge reflects robust domestic demand, improved utilization levels, strategic deleveraging, and a sharp recovery in profitability, especially in sectors like banking, automobiles, capital goods, and FMCG. This record-breaking performance was driven by robust domestic consumptions across sectors like FMCG, auto, consumer durables, aided by rural recovery and festive demand. Second, strong operating leverage and cost rationalization in sectors like IT services, cement, and industrials. Third, resilient banking and financial services performance with improved asset quality, rising credit demand, and higher net interest margins. Fourth, buoyant capital expenditure in infrastructure, real estate, and renewables, which supported earnings in core sectors such as cement, steel, engineering, and construction. Fifth, improved corporate balance sheet reflecting deleveraging over the past few years and a focus on profitability over growth at any cost strategy. And lastly, low base effect in some export oriented sectors which rebounded from weaker prior year performance. This historic performance highlights the deepening integration of India's corporate sector with its macroeconomic growth story and signals stronger confidence among investors and stakeholders going forward. The overall profit growth for NSE 500 companies stood at around 11.4% for the year, although this marked a slowdown compared to stellar around 26% CAGR seen from FY21 to FY24. Despite the record profit, aggregate profit after tax for BSE 200 companies, excluding oil marketing companies, grew just 9% for the full year, which was down from 21% in FY24. This slowdown was attributed to soft demand, weak top-line performance, and a significant drop in capital expenditure growth. Now talk about the outlook for FY26. Despite the strong profitability in FY25, the outlook for FY26 is marked by cautions due to slowing profit growth, weak demand, and capex and earnings downgrades. India's corporate sector is expected to see a cautiously optimistic outlook for FY26, with earnings growth expected to improve from a modest level of FY25. Key drivers for this growth include continued recovery in consumption demand, a favorable monsoon, potential easing of interest rates, government focus on infrastructure and manufacturing, stable commodity prices, and manageable inflation. Sectors like FMCG, consumer durables, and auto are expected to benefit from a broader demand recovery, while banks and NBFCs are expected to perform well due to credit growth and improving economic activity. However, industries, manufacturing, and capital expenditure are expected to continue their positive trajectory. IT services outlook remains subdued due to ongoing global uncertainties. Potential tailwinds include further policy reforms, successful trade agreements, and improved global economic conditions. Key risks include unfavorable monsoon and resurgence in food inflation, persistent global economic slowdown, or recessionary trends impacting exports and investment, and geopolitical escalations. Now let's talk about the top companies by net profit in FY25. State Bank of India leads with 77,566 crore profit in FY25, growing at a CAGR of 31% over 5 years. HDFC Bank follows at 70,792 crore with a 21% CAGR in the same period. Reliance Industry is not only third in profit but became the first Indian company to cross 10 lakh crore in net worth. ICICI Bank overtook Tata Consultancy Services in net profit for the first time, crossing the 50,000 crore mark with a 40% annualized growth over 5 years. LIC, Life Insurance Corporation of India, reported a strong jump in net profit to 48,320 crore from 39,000 crore from the previous year. Bharti Airtel rounds out to the top 10 with net profit surging alongside robust revenue and EBITDA growth. Moving on to the next slide. Sectoral trends and performance. India Inc.'s Q4 FY25 showed growth moderated compared to previous years but demonstrated resilience across key sectors. Government spending on infrastructure and rural programs provided a tailwind for earnings, especially for capital goods and rural-facing sectors. Sectors focused on domestic consumption, such as FMCG, capital goods, manufacturing, outperformed export-driven industries. Export-oriented sectors like IT and chemicals lagged due to persistent global trade uncertainties, soft demand, and policy-related headwinds. Mid-cap companies and those with rural exposure outperformed large caps, driven by a rebound in rural demand and government spending. Agriculture, chemicals, and telecom sectors posted robust profit growth, with telecom profits surging around 46% while agriculture, chemicals rose around 11 to 13%. However, oil and gas, metals, mining saw profit declines, while export-linked sectors struggled. Talking about the profit margin, which remained stable, supported by lower input costs and soft beginning interest rate environment. The aggregate operating margin for the quarter stood at around 21.35%. However, some net profit gains were skewed by higher other income, suggesting that core business profitability was less robust than headline figures indicate. Now let's talk about the performance in FY25. While several sectors reported robust earnings, some struggled due to external and structural factors. Notably, telecom sector in India has turned a net positive contributor to the country's profits in FY25 following a 7-year trend of net losses. This was driven by strategic tariff revisions, data monetization, subscriber upgrades, enterprise and fixed broadband push, operational efficiency, cost optimization, and network sharing. Industry-wise, revenue grew by approximately 10 to 12% YoY, with top players like Bharti Airtel, Reliance Jio, and Vodafone Idea achieving record profits and mobile EBITDA margins. Key drivers for this turnaround included gradual prepaid tariff hikes, improved cash flow management, and the early monetization of 5G services. The sector is expected to contribute more meaningfully to India's profit pool in FY26, FY27. Banking and financial services sector led the profit surge, benefiting from lower provisioning, rise in credit uptake, and improved asset quality. PSU banks posted record profit, notably State Bank of India and Bank of Baroda, aided by healthy net interest margins and recovery in stressed assets. Private banks witnessed healthy credit growth, improved asset quality, and robust net interest margin, which supported earnings. The automobile sector in India in FY25 sustained its growth trajectory, but the pace moderated compared to previous year. The industry achieved a 7.3% increase in domestic sales and a robust 19.2% rise in exports, with passenger vehicles hitting a record 4.3 million units in FY25 over FY24. Two-wheeler sales saw a robust 9.1% increase, reaching 19.6 million units. Retail sales across all segments grew by 6.5% in FY25 compared to 10% growth in FY24. Capital goods and infrastructure segment. This sector witnessed strong profit uptick driven by execution of large orders and healthy order books. Continued public infrastructure spending lifted order books and execution rates. Private capital expenditure witnessed a revival with select uptick in private sector investment in manufacturing and renewables drop demand. IT sector experienced modest revenue growth, but escalating costs squeezed margins and reduced profitability. The IT sector faced soft demand with client paused project and cutting discretionary spending, particularly on digital transformation initiatives. Global macroeconomic uncertainties, including tariff wars and recessionary concerns, delayed new project flows and vendor consolidation, further impacting revenue visibility and profit growth. The oil and gas sector was a notable laggard in FY25, with profits declining around 10.2% compared to previous year, affecting overall corporate profit growth. These sectors faced headwinds from global crude oil price declines, which affected revenues and profitability, especially for upstream companies. Geopolitical volatility and global financial market uncertainties remains risk for future profitability and growth. Now, for the rest of the presentation, I welcome Girish Santani to take it forward.
Thank you, Abhishek. Let us now dive into performance indicators for each sector. Starting with technology sector, India's IT sector faced a challenging fourth quarter in FY25, dealing with seasonal softness and global economic uncertainties, including recession fears in the US and new trade tariffs. Revenue dipped across top firms. Infosys led with 3.5% Q on Q drop, while others like TCS Wipro saw smaller declines around 1%. Attrition edged up slightly with Infosys at 14%, TCS 13.3%. Sectorial performance was mixed for the sector. Manufacturing healthcare grew steadily, while telecom lagged due to 5G project delays. Geographically, Europe, India showed strength around 3 to 5% growth respectively, while North America remained muted. Digital and data-led revenues gained momentum, while generative AI started picking up pace, with Infosys and TCS running over 220 pilots combined, though financial impact from this generative AI initiative remains modest. Banking sector. Q4 25 painted a mixed yet resilient picture for India's banking sector. The sector showed strong fundamental. Private banks like HDFC, ICICI outperformed with robust profit growth, while some public sector and mid-sized bank faced margin pressure due to higher provisioning. Strong loan growth deposit continued with HDFC deposit growth around 15%, ICICI loan around 14.5 to 16% led by retail, agriculture, MSME segments. Asset quality improved significantly with SBI gross NPA falling to around 1.82%. Treasury gains from falling bond yields improved recovery supported earnings, although microfinance exposure remained concern for the banks like IDFC and other smaller banks. Operationally, many banks benefited from tech-driven efficiencies. CASA ratios also moderated slightly due to tighter liquidity, but banks continue to expand through enhance competitiveness through UPI and tech innovation. Pharmaceutical sector. Financially, Q4 25 saw pharma companies posting strong numbers with revenue up around 19%, 18 to 19%. EBITDA margin improved to 25% thanks to cost control and operating leverage, while gross margin held at 67%. R&D spending stood at approximately 6 to 7% of sales, reflecting sector's continued investment in innovation. While volume growth remained flat to muted, sector strong fundamental in pricing innovation, specialty therapies, export growth continued. Consumer goods. Q4 25 for FMCG and consumer goods was seen transitionary, where the sector navigated a mixed demand landscape. Urban market, which account for over half of FMCG sales, remained under pressure due to elevated cost and weaker discretionary spending. Rural India emerged as a bright spot, supported by lower inflation, increased government spending, favorable crop prices. Rural demand outpaced urban by as much as 450 basis points. Companies like Jyoti Laboratories, Dabur focused on cost management, protect margins, employing selective price hikes, operational efficiencies. Even as input cost volatility, particularly in dairy and other commodities, posed some challenges. Revenue growth remained modest for the sector, with volume growth reflecting cautious consumer sentiment. Next slide, please. Automobile sector. Q4 for automobile was mixed but telling sector, reflecting industry shift towards ongoing evolving demands and cost challenges. While overall domestic demand remained subdued, especially in urban centers, rural export offered critical support. Passenger vehicles sales rose around 3% in YO and Q4, driven largely by SUV demand and success of new premium model launches. With FY25 PV sales reaching around 4.1 million units, which is up around 5% YOY. Commercial vehicle segment, however, remained flat to negative slightly, impacted by financing constraint and patchy demand. Two and three wheelers saw solid growth, particularly in rural markets, aided by improving rural incomes and government support. Exports stood out as a key growth engine, with PV export up around 15%. Auto component segment also performed strongly. Yet there are margin pressure persisted across the sector with rising operational cost and higher input prices weighing on profitability. Overall, it showcased a resilience and adaptability for the sector in the performance of Q4 25. Metals and mining. Q4 25 was steady quarter for metals and mining sector as industry delivered steady performance across aluminum, zinc, copper, iron ore, steel, and coal. Leading companies posted high production volumes driven by strong demand from infrastructure sector and export momentum continued. Export growth in aluminum, steel, iron ore provided a vital boost among global volatility. Operational excellence was also evident in improved cost management, enhanced production, greater use of recycled materials. Government Make in India and PLI schemes also further supported sector expansion. Real estate sector. Q4 25 marked period of transition for maturity for real estate sector, particularly in residential segment, following 2 years of rapid expansion. Overall value of transaction increased, driven by a marked shift toward premium luxury housing. Average property realization surged up to 24% YOY in Q4, with prices rising annually 7.4% in 48 of 50 major cities. Luxury segment stood out, posting remarkable 28% YoY revenue jump, reflecting sustained demand from affluent buyers seeking premium assets in key urban market. Despite volume moderation, developers saw collection and profitability supported by sector consolidation, stable policy, and recent rate cut by RBI. Overall, Q4 signaled a strong move toward balanced and value-driven real estate market, where quality, pricing power, premium positioning reshaping the growth narrative for the sector. Next slide. Ratios. On this slide, let us look at some sectorial ratios. Interest coverage ratio improved gradually across quarters due to margin expansion and lower interest cost. Debt to EBITDA remained stable or improved slightly, reflecting cautious leverage and improved profitability. Sectors like FMCG, retail, hotel exhibited higher interest coverage ratio owing to strong margins and lower leverage, whereas capital-intensive sectors such as power, metals continue to show higher debt to EBITDA ratios. Notably, metals and mining, fertilizer, pharmaceutical, power, oil and gas, chemical witness year-on-year margin improvement driven by better product mix and operating efficiency. In contrast, cement tire sector experienced margin contraction due to elevated input cost and weaker urban demand. Next slide. Let us now turn our attention to the outlook for key large sectors. Pharmaceutical sector. Indian pharmaceutical sector projected to grow steadily around 10% in FY26. This growth has been driven largely by price increases, which is contributing around 5%, and by a robust pipeline of new product launches expected to add to the growth. Chronic and specialty therapies such as cardiology, neurology, dermatology, oncology are outperforming broader market, driving domestic demand of around 10%. Export market also, particularly from rest of the world region, along with strong demand from CDMOs, further supporting growth. Along with price, although pricing pressure in US generic remains a key challenge, India pharmaceutical sector expected to maintain growth, supported by robust demand and new product launches and expansion in specialty and chronic therapies. Sector will also benefit from increased healthcare spending, government initiative, and export opportunities. Banking and financial services. The outlook for banking financial services is looking positive with strong credit growth, improved asset quality, healthy profitability expected to continue. Private banks and well-managed sector banks are likely to outperform, supported by digital innovation, stable macroeconomic condition. However, margin pressure from rate cut, pockets of stress in microfinance and unsecured lending requires close monitoring and can pose a challenge for the banks. Telecom sector. Telecom is witnessing strong ARPU growth, where ARPU crossed 200 in FY25 and projected to reach around rupees 300 by FY27, driven by tariff hikes. 10 to 25% tariff hike was seen for the sector in 2024 and more expected in the late 2025. The companies can also get the leverage from the user base, which is going to increase from 290 million in 2024 to nearly around a billion by 2030. With 4G users also comprising half the base, there is significant opportunity for companies to gain further ARPU and revenue. Postpaid and premium users are expanding, further boosting returns due to higher value and lower churn. While capital expenditure has been high for the sector in 24 due to 5G rollout, it expected to decline in further 2026 due to uh, reduced CapEx, which will improve profitability and debt levels for the companies. Leading operator like Bharti and Jio continue to dominate ARPU and subscriber addition. Next slide. Automobile sector outlook is looking cautiously optimistic with modest top-line growth, ongoing margin pressure. SUVs, export, electric vehicles are expected to drive demand, supported by new launches and government incentives and initiative. However, higher inventory, global trade uncertainties, and cost pressure may weigh on the sector in the near term. IT sector. IT sector faces a cautious near-term outlook with muted revenue growth expected due to global macroeconomic uncertainties, reduced discretionary spending, and new tariffs in key markets. However, sector remains resilient with strong deal pipeline, rising digital and data revenues, continued investment in AI, cloud, and cybersecurity. Over the medium term, IT sector is positioned for recovery, sustained leadership in global tech services. Also, global transformation and digital transformation spending resumes. New technology adoption accelerate the growth in the sector. With that, I now like to invite Vikrant to take it further and open the floor for questions. Thank you.
Thank you, Girish. Now we will take some of the questions that we received during the registration. So there was one question which we got. Which sectors do you think will have highest growth rate in future? Which is the industry risk in that sector? And whether banks will be able to give credit or it will be done by AIF? Abhishek, will you like to take this?
Yes, sure, Vikrant. So, future prospects or future growth drivers sector-wise would be like capital goods, industrial manufacturing sector, backed by government's Make in India, PLI schemes, and push for infrastructure and defense indigenization. CapEx cycle recovery, along with strong order book visibility, rising private sector investment augurs well for this sector. Further, integration of Industry 4.0, AI, and IoT in green manufacturing also supported growth visibility.
Thank you, Abhishek. If you can see if there's any other question in the chat. Okay, I don't see any other questions here.
Or even I can't see any question in the chat box.
Sure. So
Yes.
with that, let's wrap up the webinar. Thank you all for joining the webinar today, and we look forward to seeing you in our future events. Thank you so much.
Thank you.
Thank you, everyone.